All right, understanding the topic fake tops and fake bottoms. And that understanding starts with the first slide, which is the origin story right there. And before we dive into the origin story, I want to go over that it's also quite a subjective topic. Now, the reason why it's important to understand is because once you start doing your own case studies, and that's quite important to understand the topic, then you will see it and you won't unsee it anymore. So that's very important to do your own case study, just like other concepts as well in the spring enrollment. But I would argue this topic, especially if you want to understand it, case studies, you need to do them. They're almost obligated. They're mandatory if you want to understand it. Now, I've tried to make it as mechanical as possible, as objective as possible as well, so I can give you a head start to that understanding, but case studies will finish the understanding fully. So let's start with the origin story. So you can understand the story, and that story leads to then the understanding of a fake top cycle as well. At the end of 2022, before the MMT started, I was very interested in understanding how we can understand what a real reversal is in the market. So how real tops and real bottoms are formed in the market as well. And whilst doing that, of course, as you may know, I want to do my own study. So I don't go asking to other people, hey, do you know this? Do you know that? No, I want to do my own study and find it out for myself. Perfect. So I had my notion, did a deep work session, did a case study. And the first thing I noticed is whenever we expect a top or a bottom in the market, it sweeps one more time to then continue in the intended direction as well. And what that leads to is the understanding of we have a fake top. We then have a sweep one more time, creates the sharp turn, the sweep right there. Then we have the reversal, which is the sweep overall, which is the unusual context as well, to then create order flow to continue lower. So all these concepts, they tie in together. So if we understand a fake top, we understand where we want to see the sharp turn. We understand where we want to see that order flow right there. We understand what the target overall is. And that leads to a fake top cycle. So right here, we have a fake top cycle right there, where step number one starts with a flag pattern and or a swing failure right there. Now, I just want you to have this visual idea of what we want to see. And it does not need to be an exact flag pattern according to certain rules. It does not need to be an exact swing failure according to certain rules. As long as you see the pattern that's forming, that's important. It starts with a pattern where the bullish candles are overlapping. So again, this does not need to happen all the time, where the bullish candles are overlapping everything that's inside. And what that looks like, I'm going to show you in a little bit. But that does tend to happen when we create a fake top. So what is a flag pattern? What is a swing failure? What are those overlapping bullish candles right there? Well, to start off with the first example, this right here is a flag pattern. And this is a retail pattern. So this is what retail traders actually quite often use. This is also what, for example, big institutions use. Now, you can potentially already see where I'm going with this if we're talking about a fake top and we talk about a flag pattern that retail traders or institutions actually use. They have the liquidity theory. So understand that, because that is very important as to why we sweep that fake top and then continue lower. That's what it all starts with. Now, this is then what they call the flagpole right there. Here we have some resistance and support. And what we know as we have probably a fair value gap in this leg right there. And then we continue higher, targeting that high right there. Just simply usual context that we have. Now, this is very interesting. And if we now use this understanding to look at a swing failure as well and look at those bullish overlapping candles. A swing failure is the following. It's based on market structure. So you have two patterns. You either have a breaker pattern, which is this right here, but you also have a swing failure pattern. A swing failure pattern is the following, where we create a high right there. We push lower and we push higher, but we never take out that high right there, which we do in a breaker pattern. And afterwards, we push lower again, below this low right there. Very similar to a flag pattern. Now, right here, you can potentially see what if this is this right here. This swing failure is actually the first high that we create in that overall breaker pattern that we have. Which, if we take a look at this market, this is a swing failure. This is also known as a flag pattern right there, where we have this area and where this high right now becomes important. Again, where we continue higher off of Yes, it helps to understand. You might think, well, Arjo, why don't we just look at a simple discount array which we can continue higher off of right there and saves us a lot of headache, right? You are correct. But that does not happen in every instance right there when we do have a fake top. And sometimes we already create a fake top right there, which can be used as a target. But other times we come into a premium array, which we expect lower prices off of, and we also have a fake top right there. And that is exactly where we need to be very careful that we're not trading off a fake top right there. So before we get into step 2 and how we can know that we're not trading off a fake top, let's discuss those bullish overlapping candles. Oftentimes, what we will see when we create a fake top is we will have, again, that swing failure, that flag pattern right here, which creates one-sided candles right here. And all those, in this case, bullish candles, because it's a fake top, they overlap everything that's inside, that's happening inside of those bullish candles. Meaning, if we take a look at this scenario right here, then here we have all these bullish candles. They overlap everything that's happening inside right there, which creates this flag pattern, which also has, again, the same exact swing failure that we talk about right there. And then we take out this fake top right there, and we actually, in this case, continue higher. But that is oftentimes what you will see. Now, how can we actually confirm that it is a fake top or that it is a fake bottom? Because the pattern is the first part. But the second part is very important, because the second part is the failure to displace. We fail to create any fair value gaps. Now, again, like we mentioned earlier, we can come into a premium array. We can also be in a random spot in the market, like we saw in NASDAQ. The example that we showed is just at an all-time high. We can be, it's, by the way, very good to see if we actually want to continue lower and we want to short price action. So we want to look for short and we are at an all-time high. Those fake tops will give you a very good understanding of when it's actually valid to look for short in an all-time high scenario where you're not necessarily picking a top or a bottom anymore. That's very important, very interesting as well. But it doesn't really matter in what scenario we are. It can be a PD array, can be again, like in thin air, does not really matter. As long as there's a failure to displace, we fail to create any fair value gaps going lower in this case, because we're talking about a fake top or a fake bottom, we fail to create any fair value gaps going higher. There's no real displacement. Now later on in this finishing touch month, we will go over how we can spot as well consolidation and price action. That's what we want to spot. And how we can spot that is a lackluster price action. What is lackluster price action? When we don't create fair value gaps. Now that is very obvious lackluster price action, where we don't have the intention. Less obvious lackluster price action is when two candle rejection, for example, is not perfect. The first candle does not reject, is very lackluster to reject. We create ugly fair value gaps, we create this ugly price action, which then leads to consolidation. But that leads to the understanding that we are failing to displace. So even if we have a fair value gap and the two candle rejection inside of that fair value gap is very ugly, we might still create a consolidation. We might still create that fake top right there. So that reading is very crucial. Now, then once we have that failure to displace, which looks something like this on NASDAQ on the 4-hour right here, it's quite obvious that we have a failure to displace, because again, we don't even have fair value gaps. But even the combination and how we combine those time frames is very important to understand here. Now on the 1 hour, we already had this flag pattern, this fair value swing failure a little bit earlier right here with this low as well sitting right there. And what I meant with, we can get a fair value gap right there. But when we do not have the perfect displacement of the fair value gap, so for example, in this case, in this candle right here, we should have continued lower. We should have now created a bearish fair value gap to continue lower again. But now we create an up candle. That's an ugly two candle rejection. That's also a sign that we are failing to displace lower right there. So not only the creation or the lack of creation rather of fair value gaps is a sign that we are failing to displace lower. It's also an ugly two candle rejection right there. That's quite important to understand the next step. Because now step number 3 is that we have a sweep right there. We get a sweep of the fake top and the real top sets in. A sharp turn happens right there. So what does that look like? Well, right here, we have this fake top. We eventually continue higher right there. And now we get the sweep. It's also important to understand what is then a sweep versus a run on liquidity. All the topics that we've already gone over in the spring enrollment as well. At first, we might say, well, we are potentially running this because we have a fair value gap overlapping right there. And we could very well retrace back into it to then continue higher right there. So it could very well be a run. Is it then a fake top? Well, in hindsight, it could be. But right now, it could not be a fake top and we could just continue higher. But then what happens? Well, right here, we get an expansion phase candle coming back to that fair value area that we have also created right here, right there. Back to that fake top right there, which creates the fair value area. And at this moment in time, something should start clicking, which is the exact realization that we had in the live session, if you're interested in that. And that was on the 20th of June on that Thursday, where we mentioned, well, this does not look very good, that we do still want to continue higher. This might be very interesting for lower prices, actually. Targeting then this low sitting right there. So we had this fake top, and that fake top right there, before we even get the sweep, towards that fake top, once we start to see order flow starts to fill on the lower time frame, we get fair value gaps going higher right here, then this high can actually be target. Without needing to know what we are actually going to continue higher off of, we can simply use this fake top as a target right there. And afterwards we can see, are we running it? Are we sweeping it? And then everything starts clicking and we have the full schematic. So here we have the fake top right there, the flag pattern, step number 1. Then we have second step right there, failure to display is lower. Perfect. Then the failure to display is lower, once we start to displace higher actually, can be used, the fake top right there, as a target to trade towards higher right there. And afterwards, the highest probability price action happens right here, where we start to create this sweep right now. And this right here is where we can then continue lower off of. And this is where step 4 comes in, which we've already marked out right there as well. Because step number 4 is the target. After the sweep, we target the flag low, the unusual context, which is again the flag low, but it's also simply said, of course, the fair value area low, because it's simply this low right there. And this right here is the fair value area. Now, why does this work and what is the theory behind it as well? Because why does it work? Essentially, let's start off with that. Well, why does it work is if that flag pattern, like we said earlier on, is that if that's something that institutions use with major liquidity, those are known as breakout traders, etc., like we mentioned as well earlier in liquidity theories, etc. Then why does all this work? Well, because we're trapping breakout traders at this moment in time. Why? Because this flag pattern for a lot of retail traders, and again, I'm not referring, when I refer to retail trader, I'm not referring to the average Joe even trading 10 lots. It's not relevant. We're talking about insane lot sizes, 10,000s of lot sizes. That's what we're talking about here. So when those institutions and the big whales, let's refer to them as that, when they see this move happening right here and they have their flag pattern happening right there, we're at an all-time high as well, we can potentially continue higher, then what happens right here? Well, they have their stop loss below this low, which is our fair value area low right there. They have their entry above that high right there, because now it's breaking out. It's showing strength above that consolidation right there. Perfect. We can just simply target higher right there, right? So we have this liquidity trap right now. And as soon as we get that sweep, which happens fast, again, that's why a fake top is slow. It's just to lure in traders. A fake top is very slow. We're not trapping people, etc. And that is important to understand, because when we have that sweep right there, then this low becomes the target, because that's the stop loss, where the stop loss is. Trapping traders right there, targeting the liquidity, where the take profit can be met right now with those stop losses. And that is very important. That's the whole theory. That's the whole thing, why it even works in the first place right there. So afterwards, if we do want to continue lower, then what have we now created? We have created that breaker pattern that we saw earlier, where this turns into the fair value area as well, which we can potentially continue lower from right there. But even here, we see the same thing, right? We see this continuation lower right here. We create this bottom in the market right there. We have a failure to displace. If we now want to continue higher and we do want to sweep this low, then what will happen? We have this fake bottom right there, and we create this sweep to then target this fair value area, for example, to then potentially again continue lower, creates this ping pong price action. Now, At first, spotting those fake tops and fake bottoms, you might only see it once it happened. So in hindsight, for example, right here, after the fact, you might say, oh wow, there was a beautiful fake top right there, which we could have targeted. Because again, we are going to most likely target this high before we even continue lower, because this is the catalyst for that move lower. It's the premium rate that we are going to continue lower off of. So trading towards a fake top is actually very beneficial. It can deliver very nice trades as well. For example, with this value gap right here, that can be very nice. And afterwards, we just trade with the big wheels. So now we follow the footprints going lower again right there, which is, again, super interesting. And we can capitalize on that, especially in a flow trading plan as well, filtering process trading plan as well. But it happens less, of course, on the higher time frame, less frequent at least. Now, like I mentioned at the beginning, this will be a little bit more difficult to spot. You might only see it in hindsight, but once you see it over and over and over again, then you will see a fake top before we actually sweep it, before we then continue lower, and you can capitalize on the full move. And that makes it super interesting. So you need that experience as well. Never forget that you need that experience. And that's why sometimes in a live session, I mention, well, this definitely looks like a fake top or fake bottom. That's just purely experience. I understand this, but I have the experience because I've seen it play out over and over and over. But of course, if you never understand the steps, then you also don't know what you're paying attention to. That's why these steps are very important. Now let's go over a few more examples. So here on ES, we see something very interesting, and it's very similar to NASDAQ, but a little bit different. Now right here, we also get this fake top right there, but we never get the displacement lower. So we never get that sweep afterwards. And that's also important, right? Because otherwise we're just running that high and we can just simply continue higher. And afterwards, we see here this overlapping bullish candles right here, which we could also argue is also a fake top, right? Yes, but we get immediately right there afterwards displacement lower. So if one step does not fit the criteria, then there's no fake top, right? That's very important to understand. We can have the fake top, we can trade towards it. That's the first step. If we don't sweep it afterwards, there's still nothing to do. Then we have traded towards the fake top, which is a good thing. But afterwards, we don't sweep it. So it's very important. React still. Very important. Always reacting. All right. So here on Bitcoin, we have a really interesting fake top sitting right there. Can you see the bullish candles again? Creating that weird top. And afterwards, we have displacement. Yes. But we have lackluster price action towards both sides of the market, which creates that consolidation. And afterwards, once we do get that displacement and we actually crawl towards that fake top right there, we see we have a daily value gap, which we can continue higher off of. That's perfect, because then we can capitalize on the move right here towards the fair value, towards the fake top. Then after, what do we have? We see right here, the sharp turn gets created right there. And after, we can capitalize on the move towards the low of the fair value area, which is actually this low sitting right there. And that is an exact same example of a fake top in the market. Or for example, right here on Euro US dollar with this high right there. We try to push lower, and on lower time frame, we do indeed have fair value gaps, but on the 4 hour, we fail to create the fair value gap. Then we have these bullish fair value gaps and these bullish candles, fully overlapping everything that's inside at that moment in time. We continue higher towards the fake top, takes a little while, and afterwards we sweep that to then continue lower. This is a fake top and a fake bottom. And this is thus far, maybe with more experience I can explain it better. This happens everywhere, every single time, over and over and over. It happens so extremely much right there, fake top. We can trade towards it in the beginning right there. Then after we sweep it, fair value area, all goes hand in hand with one another. The only way to really understand this is use the framework that we have right here. Then see fake tops and fake bottoms in hindsight. So just like I'm doing right now with this fake top, for example, right there, which we run right there, then turns into fair value area, which we then respect. So we don't sweep it. Very important. And do this over and over and over and over and over again. Start seeing it in real time. Start getting better at it. And you will notice those fake tops and fake bottoms before it turns into hindsight and we've already had the sweep, etc. And that is, can't emphasize that enough, that is a very crucial skill, because this happens a lot. And if you want to, for example, trade all-time highs, then knowing this and having this skill in your back pocket is very important, because then you know and you can be quite confident in understanding, hey, now I do actually want to look for shorts when we are at an all-time high. That is very crucial to understand. All right, perfect. Thank you.